most difficult element that you need to master in this investment and financial analysis, yeah, which is internal rate of return. Okay, I'm not sure, yeah, whether you already learn this internal rate of return before. Okay, but if you learn before, that might be too difficult technique. I think I will have a technique that might make you quite easier, yeah, for you to answer. Yeah, there are some tips on answering IRR. Okay, so let's have a look at this chapter 6, which is discounted cash flow techniques. Yeah, okay. So this chapter, we're talking about the chapter is look alike capital budgeting. Yeah, okay, capital budgeting on financial management. Yeah, it's just that there is an additional features of calculating internal rate of return. Okay, so let's have a look at the overview here. Yeah, basic investment pattern nowadays is follow the same recurring pattern of near-term outlay followed by the promise of attractive future return. Okay, this is quite fancy word, yeah, for you to understand. In other words, yeah, that you learn during financial management, yeah, is okay, today, yeah, there will be cash outflow. Yeah, that means money out, which is because of investment. Okay, but for future, yeah, there will be stream of revenue, which is inflows. Yeah, we're talking about revenue. Okay, because the investment is needed for you to generate an asset. Once you have an asset, you can use it for operation, and then once you have an operation, you can have customers, you can have some prospect, and then they will pay for your services. Yeah, so that's why today is investment, future will be revenue. Yeah, so therefore the investment challenge is to decide whether the uncertain future returns justify the current outlays. Okay, why uncertain future? Because the inflows here, we're talking about projected. It is not a real income, but it is a projected income. Okay, let's say today, today I want to open a new amusement park, let's say. Okay, in 5 years time, I'm projecting what will be my revenue. Let's say first year I'm budgeting to get 10,000, second year 20,000, third year 30,000, and so on. So that is a projected doesn't necessary to be the real one. That's why it is uncertain whether it is true story or not. There will be another matters. Okay, therefore, a discounted cash flow technique is commonly used to estimate the expected profit from the investment. DCF technique, which is similar to what we learned during financial management last time around. Okay, figures of merit. What is the figures of merit? Okay, the financial evaluation of any investment opportunity involve the following 3 discrete steps. That means we're talking about what we call as limit or ceiling, or we're talking about benchmark. Okay, sometimes they need to meet the benchmark in order to make the project evaluation very good. Okay, let's say if the target is to get 1,000, therefore the benchmark or merit is 1,000. If they pass the 1,000 limit, yes, that will be very, very good. That is a merit. Yeah. Okay, so there are 3 steps in figures of merit. The first one is to estimate the relevant cash flow. Okay, that means you need to project it out the year by year. Yeah, but usually the relevant cash flow is given already. Yeah, the second one, calculate a figure of merit for the investment. Okay, so that means you need to calculate what are the criteria of discounted cash flow. Compare the figure of merit. Okay, this is like similar to the last time around. Once you calculate, and then you need to compare to see whether the project is acceptable or rejectable. Yeah. So it's a number of summarizing an investment economic worth rate of return. Okay, and then acceptance criterion. Okay, this is we're talking about a benchmark here. If the answer is beyond the limit, that means it is acceptable. It is standard of comparison. We're talking about you compare A with B. That helps an analyst to determine whether an investment figure of merit is attractive enough to warrant acceptance. Okay, we're talking about benchmark. We're talking about target. If the answer meet the target, yeah, therefore the project is very good and acceptable. If the answer is not meeting the target, not meeting the benchmark, yeah, the project will be in a big trouble. Okay, so using time value of money, okay, which is in terms of PBIF, usually we talking about present value, interest factor. Because remember that cash flow is more on future value. Okay, so therefore from future value we want to calculate as a discounted present value. Yeah. Okay, so the time value of money has to be taken in consideration as a challenge to estimate figure of merit. Okay, bear in mind that today's value is not similar to future value. Okay, let's say 100 ringgit. Yeah. Okay, in the future, it doesn't mean the 100 will become 100. It will become 110, it will become 120, because the value of money is increasing day by day because of inflation. Yeah. Okay, so why time value of money is to be taken as a consideration? The first one is because cash deferred imposes an opportunity cost. Okay, because remember that project you cannot pay by cash totally. So that's why they make a deferment. Deferment means that they will make an installment. They delay the full payment and then they will make an installment. Okay, that is the first one. The second one, inflation reduces purchasing power. That's what we're talking about. Yeah? From 100 ringgit, the future will become 110 and 120. Can you imagine? Yeah, because of the inflation, okay, your value of money will become decreasing. Okay, let's say I'm talking about the analogy of sugar. Let's say you have 10 ringgit. Okay, let's say today the 1 kilogram sugar is like, let's say like 2 ringgit. So therefore, you can buy 5 bags because 10 ringgit divided by 2 ringgit per kilogram. So you get 5 kilogram. Okay, what happens if let's say 1 kilogram because of the inflation, it will become 250. From 2 ringgit to become 250. You only able to buy 4 kilograms of sugar. Yeah, so that's why if the price is increasing, therefore the quantity that you purchase is decreasing. So that's why inflation reduces purchasing power, because if the price is increasing, you can only buy little. Same goes to the project. Okay, later on you can see that the project is become more expensive. Yeah, if you want to buy a house, you can only buy a house at the minimal quantity. Yeah, but somehow the spec is quite different from the years before. So that is taking a consideration. Okay, the last one, risk customarily increases with the futurity of cash flow. We're talking about the volatility of price, whichever price is increasing or decreasing, it will impact the cash flow future. Okay, it depends on the we have a lot of risks, types of risk, which is business risk and also financial risk. Okay, so there are four calculation required in this one. Comparable with the last time around, when you learn financial management, you need to calculate payback period, net present value, and accounting rate of return. That's it. That one is for financial management. However, this is a special calculation that you need to do for this module. Yes.
Dia punya buku habis dia pinjam dengan library habis 3 hari sebab tak saya buka aku bagi pembahas itu yang separuh semua buku tadi.
Hello, I'm in class right now.
Hi, sorry.
I'm in class right now. Okay.
I paste a Google form.
Okay. So there are four analysis of this one. We're talking about this one that covers in financial management. But this one is an additional features in IFA, within investment and financial analysis, because this is quite technical for you to calculate. So once you master this one, that means you already very good in financial analysis. We're talking about investment analysis. Okay, payback period, this one you already done, but I will show it again. Yeah, how long? Yeah, I mean indicate the time for company must wait before recovering or recover original investment. Yeah, in other words, how long that a project that can cover back their investment. Yeah, the faster that will be, the better. Okay, accounting rate of return. Okay, this is multiply actually. Yeah, correct. Annual average cash flow divided by investment multiply by 100. This is want to see the rate of return get from the project every year. Yeah. Okay, the ratios between cash inflow versus cash outflow. Okay, and then net present value. Okay, this one is done by table. Present value of cash inflow minus present value of cash outflow. This is done by table. Okay, and yeah, this is the table that I'm talking about that we already learned in last time around in financial management. But today, it's not wrong for me to have it again. Okay, this is internet rate of return. Okay, whereby we want to calculate the expected return minimum, yeah, for the project if your NPV is equal to 0. This is the key. Yeah, this is the key. Yeah, because if you want to see whether you can okay, so to see what will be the rate of return if NPV is 0. That means return is equal to what if NPV is 0. Okay, this one is complicated because you need to do interpolation. Okay, we're talking about interpolation means that you want to calculate the accurate rate, because we have two range, upper range and lower range, and then somehow in between that we need to calculate the exact amount. Okay, these are the formula. Later on, hopefully when I show the demonstration, you will have some understanding there. Okay, so these are the acceptance criterion. Okay, this you already learn during financial management. Payback choose the fastest. Okay. Okay, this one choose the highest. This one choose the highest, and this one also choose the highest. Okay, let's have a look at this example. Okay, this is quite different with financial management because in financial management, you will be given two projects. Let's say project A and project B. Okay, and then you need to calculate two projects, and then at the end of the day, you choose which one is the best, either project A or project B. But for your IFA, we are more talking about single project. We're talking about only one project, single project. These are the target. Okay, to ensure that your payback period answer is better than this one, target 3.5 years, or your accounting rate of return answer is better than this one, NPV, and also internal rate of return. So the question is to calculate the figure of merits. That means you need to calculate the answer, and then once you calculate the answer, and then you need to perform analysis by comparing with the benchmark or indicators. All right, so okay, let's have a look at on how to answer this one. Okay, so this one an example. Okay, let me solution. But before that, there is a one thing that I don't know whether I already uploaded or not. I think I should done it earlier, which is appendix. I should done this one earlier. Okay, appendix. Okay, stop presenting for a while. Hold on a second, Okay, so I already in the Google Classroom I already put this one, yeah, appendix PBIF. Okay, so you can refer later on, yeah, if you want to calculate NPV and also to calculate IRR later on. Okay, so this is the PBIF table, yeah. So I believe that you already familiar with it, eh. Okay, so let's have a look at the question, yeah, which is this one, eh. So, okay. Tenaga Tech Berhad is considering this one project, yeah, which required an initial outlay of RM 160,000. Okay, this is your investment. We're talking about your investment. The cost of capital is 12%. This is your return. Below here are the cash flow information and acceptance criterion regarding the project. So here are the cash flow. Yeah. Okay. Therefore, your year zero is 160,000. It should be negative because investment. Yeah, investment should be negative. Okay. And then there is acceptance criterions, which is the indicators that you need to compare later. Okay, so the first one, you need to calculate a payback period. Okay, so last time around, yeah, you already done that. Okay, first thing first is you need to calculate payback period. Okay, so to calculate payback period, what you have to do is you need to insert a table. Okay, year, cash flow, okay, and then cumulative cash flow. Year 1, year 2, year 3, year 4, 5.
Alternate assignment until chapter 6 will come up, right?
Everything until chapter 8. Until chapter 8.
So
Okay.
next week we got class.
No class because remember that last week that I'm not able to make a class because of I having a meeting, but I already make a recorded version of this one. Okay, if you look at my YouTube channel, I already done the recorded version of chapter 7 and chapter 8. Okay, if you look at my YouTube channel, this one.
And
Can you
also
see the
for
screen?
the financial management.
Yes. Financial management, we're talking about that on Friday. Now we're focusing on this one. Okay, this one, yeah, investment and financial analysis. If you look at this full playlist, okay, I already done chapter 7 and chapter 8 recorded version. So you can have a look. If you have a problem later on chapter 7 and chapter 8 investment and financial analysis, please let me know, if you do.
So
Okay.
Friday we have class.
Friday class as usual,
Okay.
That one will be another story. That one I will brief you on financial management. Financial management is financial management. Do not mix it yet,
Okay.
Okay. So let's have a look at the solution. Let's go for solution. Okay. Cash flow is this one, Okay, cash flow is this one. You need to copy and paste. Okay, which is this one, 43,000. Next is year 2, 45,000. The third one, this one, 51,000. Year 4, 54,000. The last one, 46,000. Okay, for cumulative cash flow, you need to what we call as accumulate year by year. Okay, for the first year is same, which is 43,000. Okay. Yep. Okay, this okay with that. We're talking about the first one, cumulative cash flow. Okay, that is the first year. But for the second year, for accumulative cash flow, you need to add up with this one. 43,000 plus 45,000. Okay, where is the calculator? Okay, 43,000 plus with 45,000, you get 88,000. Okay. Where is it? 88,000. Okay, and then for the year 3, okay, and then for the year 3, yeah, bring it down there. Okay, add up and make it an answer. Okay, so 88,000 plus with 51,000, which is 139,000. Okay, same goes to year 4 and year 5, yeah. Okay, whereby add up and then add up. Okay, so that is how you do cumulative cash flow. Okay, for this one, 139 plus with 54,000, 193,000. And the last one, plus with 46,000. So you get 239,000. Okay, that is first step. Yeah, however, yeah. Okay, the initial outlay or investment is 160,000 here, this one. Okay. Here, 160,000 you cannot see. You cannot see 160,000. Okay, I put this. Okay, 160,000. There is no 160,000. However, 160,000 is somewhere between this year and this year. Yeah, year 2 and year 3, which is 160,000. Okay, so what you have to do is, you need to draw a table, not a table, a shape. Okay, no fill. And then
No, sir, like 3 to 4.
no,
100
2 to 3. 160,000 is between 88,000 and oh, sorry. Thank you. Down there. All right. Down there. Yes, thank you. Should be eraser. Okay, hold on. Should done that. 160,000. Okay, thank you. 160,000 is here. Okay, so this is A, and then this is B in the box. Okay, so payback period is equal to year full recovery plus investment minus A divided by B, close bracket. Okay, for year full recovery, alright, between year 3 and year 4, you need to take the earliest one, therefore, because we expect the answer will be 3 point something something, because the answer is between year 3 and year 4. So we take the earliest, which is 3 years, plus with, okay, investment, earlier we're talking about initial outlay, this one, 160,000 ringgit. Minus A. A is here, 139,000. Divided by B, which is 54,000. Okay. Alright, so once you're done, okay, so solve the bracket, 160,000 minus 139,000 divided by 54,000 plus with 3 years, which is 3.39 years. Okay, so that is the answer. So the answer is between 3 and 4. Therefore, the answer is 3.39 years. So that is first answer. Okay, for payback period. You already calculate this one. This one is done. Okay. The second one is to calculate accounting rate of return. So to calculate accounting rate of return, okay, so the formula will be average cash inflow divided by investment multiply by 100. Okay, so these are the cash flow. So these are the cash inflow. Yeah, you can take from this one or you can take from this one also same. Yeah, so you still can get the same answer. All right, so you need to average it. So which is equal to have to do it by this. All right. Okay, which is 43,000 plus with 45,000 plus with 51,000 plus with 54,000 plus with 46,000 divided by 5. Okay, why divided by 5? Because there is 5 figures or 5 years. 1, 2, 3, 4, and 5. So which is 5 years. And then your investment in this case is 160,000 initial outlay. And then multiply by 100. Okay, so after that, yeah, average it, which is 43,000 plus 45,000 plus 51,000 plus 54,000 plus 46,000 divided by 5, okay, which is 47,800. Divided by 160,000 multiplied by 100. Okay, so if you press calculator, okay, you will get the answer of 47,800 divided by 160,000 multiplied by 100. So you get answer of 29.88. Take two decimal points. 29.88%. Okay, so that is the second one. Okay, which is accounting rate of return. Okay, the next one, yeah. All right, the second part is done, which is accounting of return. Now, yeah, we want to calculate net present value. Okay, so net present value, is it similar with financial management that you need to do a table? 4 columns. Year. Okay, we start with year 0. Year 1, year 2, year 3, year 4, and year 5. And then net present value. Okay, shrink it. So, okay, PBIF, discounted cash flow. Sorry, PV of CF. Okay, for cash flow, yeah, just write down, yeah, year 1 until year 5, same thing, yeah, which is 43,000, 45,000, 51,000, 54,000, and the last one 46,000. Okay, you might questioning me, okay, what happened to year 0? Okay, remember, year 0 is an investment, which is this one, initial outlay of 160,000. This one is already year 0. But since this is an investment, so therefore, yeah, the nature of the cash flow is negative because it is money out. So, you should put as a negative sign or bracket sign indicated there is a negative, which is 160,000 from the question. Okay, so that is a thing about year 0. Year 0 means that it is today, referring to today. Okay, let's have a look at PBIF. In the question, we're talking about cost of capital of 12%. So therefore, for this one, you need to calculate PBIF 12%. Alright, so how to find PBIF 12%? Okay, go back to this one, the appendix that I given to you. Okay. Okay, have a look at this one. This is 12%. Yeah? As you can see, this one is 12%. Okay, and then this one referring to year 1 until somehow until year end lah, yeah. Okay, the problem here is there is this one is PVIF 12% year 0. Okay, if you find this one, there is no period 0 there. So therefore, yeah, we can put this as dash. Dash means that not available. Yeah? Do not put as a 0. If you put 0, that means later on, yeah, if you want to calculate PV of CF, yeah, the answer will be 0. Therefore, the cash flow is gone. Yeah, so therefore, that might be a big error there. So this one I put dash, that means it's not available. Okay, how about this one? 12% and 1. Okay, so you refer to this one, 12% and 1. Okay, read the coordinate and you can get this one, 0.8929. Okay, so just put here 0.8929. That is the first value of PBIF 12% 1. Okay, next, PBIF 12% 2. 12%, 12% and 2. This one, 12% and 2. So, refer this one. So, you can get this value, 0.7972. Okay, the third one is you can go down there, 12% and year 3, use your ruler, 0.7118. The next one, 12% year 4, which is 0.6355 is here. And the last one, year 5, 12% 5, 0.5674. Okay, so done already. Okay, so therefore, to calculate PV of CF, the formula is column number 2 multiplied by column number 3. Yeah, this one multiplied by this one. Yeah, multiply. Okay. Here, you can see 160,000 multiplied by not available. So you need to maintain as a 160,000. That is the first thing. Okay, however, for first year, this cash flow 43,000 multiplied by 0.8929. So 43,000 multiplied by 0.8929, which is remove the cents. Yeah, you just take the nearest ringgit. 38395. Okay, next. 45,000 multiplied by 0.7972. 0.7972. 35874. Next, 51,000 multiplied by 0.7118. You get 36302. Next, 54,000 multiplied by 0.6355, 34317. And the last one, 46,000 multiplied by 0.5674, 26100. Okay, so you add up all these things and then this one minus 160,000. So 2,600 plus with 34317 plus with 36302 plus 35874 plus with 38395 minus 160,000. 10. This one, 10988. So this is the answer of net present value. Okay, so we're done with this question C, which is net present value. Okay, so let me check if you have any issues. Okay, I think so far is okay. Presenting. Okay. Now we are moving to the most difficult part, which is to calculate internal rate of return. Return when NPV is 0. Okay, so you need to calculate a return when NPV is 0. Currently, we have NPV, net present value, 10988. Okay, how do we want to calculate when NPV is 0? Okay, so copy back this table. However, you need to add up another 2 columns. Column to the right and then column to the right. Okay, The purpose here is we want to have a gap between, because since MPV is 0, we want to, this is positive, we want to find a value of negative. So once we got a negative value, this one is a positive value, so we can do interpolation. Okay, so how to reduce NPV? Okay, in this slide, okay, not in this slide, in another slide. Okay, I give you some tips, yeah. Okay, to reduce NPV or to make it negative, you need to increase PBIF. Okay, for let's say 12%, you need to increase, let's say, until as far as you can. Let's say in this table you can have like hold on a second. Currently 12%, probably you can go up to 16 or 18 or 20 or 22, as long you can get the negative NPV later on. Usually I go far away because usually far away you can get quite a negative answer that you want. However, yeah, let's say if you want to increase NPV, yeah, let's say your original answer NPV is negative, but you want to make it positive. You make positive, therefore you need to decrease your PBIF. Decrease PBIF means that originally, let's say 12%, okay, you need to decrease by, let's say, going down a little bit, like 10% or 9%, 8%, 7%, whichever that you feel that you can get the negative answer. Okay, so now, yeah, because this is a positive, now I want to find a value of negative. So therefore, to make negative, I will increase PBIF. Okay, let's say I'm going for PBIF. I have an option in the table. Okay, let's say I'm going far away a little bit. Original 12%. I want to increase more. So let's say I'm going to, let's say 22%. Let's say, because we want to test. Interpolation is about testing. Let's say 22%. Okay, now, this one is not available. Okay, however, PVIF 22% year 1. Yeah, you need to find value 22% year 1. Yes?
The 22% at year 0 actually is negative 160,000, right?
That one is this one, PV of CF. Later on, this one, 160,000. Yeah.
Okay.
This one we want to find the value first, a value in the table. Okay, so now move on to PVIF 22% and year 2. Okay, if you look at the table, it's 0.6719. By looking at PVIF, you already know that it's a reduce. Yeah, because you increase the interest. Okay, and then 22% year 3, you will get 0.5507. Okay, and then the next part is 22% year 4, 0.45. And the last one, 22% year 5, 0.3700. Okay, so press the calculator. This one I delete. Okay. This one multiply by this one. Yeah, this one multiply by this one. Sorry. This one multiply by this one. I'm sorry about that. This one. Because you want to find PV of CF, right? This cash flow multiply by this one. You get this answer. Probably I put here as a yellow one because to avoid a confusion. So I just put yellow to avoid confusion. This one is another part. This one is another part. Okay, so 43,000 multiplied by 0.8197, which is 352.47. Okay. And then 45,000, this one, multiplied by 0.6719. 30236. Okay, the next one, 51,000 multiplied by this one, 0.5507. 28086. Okay, the next one, 54,000 multiplied by 0.4514. 24376. 24376. And the last one, 46,000 multiplied by 0.3700. 17020. Okay, so you add this one, everything, and then you minus this one. So let's see if you can get negative answer. 1 plus with 24376 plus 28086 plus 30236 plus 35247 multiplied by 16, minus 10. Yeah, you can get this one, negative 25035. Okay, so since you get this negative value, then you can perform an interpolation by 0 at the middle. Okay, so that is we talking about to do IRR. That's why IRR usually high marks. Okay, let's have a look at to do interpolation. Okay, to do interpolation, which is do a table a little bit. Okay, so rate. Okay, and then NPV. Okay, the first we have 12% and 22. So you take the lowest one, 12%, and then this one 22%, and this one will be your IRR. This one will be your answer. Okay, your NPV for 12% is this one, 10988. Okay, IRR usually your NPV is 0, and this one is a negative, negative 25035. Okay, so you make an interpolation. So to find RRR, the formula will be, okay, let me check the formula. Sorry, not this one.
So why the IRR is 0?
Okay, because we want, okay, you see the definition of IRR is the expected return. You see the expected return or minimum. We want to find the minimum return because NPV is a profit, Yanisha. We want to see if the profit is 0, how minimum they can get the return. Okay, so because we want to find the lowest return, the minimum, because profit is 0. Yeah. So that is why we, NPV is 0. We want to calculate IRR. Okay, so the formula will be, okay, let me check. Lowest rate plus width okay, NPV at lower rate multiplied by highest rate, lowest rate. The formula usually given, and then divided by NPV at lower rate, NPV at higher rate. Okay, done. Okay, so this is the formula IRR because of interpolation that we have done. Okay, lowest rate plus with NPV at lower rate multiplied by highest rate minus lowest rate divided by NPV at lower rate minus NPV at higher rate. Okay, so I'm sure that you probably not understand how to get this one. Okay, lowest rate. Okay, have a look. The word rate here referring to this one, rate. So lowest rate, that means between 22 and 12, that means which is 12%. Yeah, between 22 and 12, the lowest is 12%. Okay, and then okay, NPV at lower rate. Okay, NPV at lower rate, this one, the lowest rate is 12%. Therefore, your NPV at lower rate is 10988. Okay, multiply by highest rate minus lowest rate. That means 22% minus 12%. This one, 22% minus 12%. Okay. And then divided by NPV at lower rate again, which is 10988 because at the lower rate 12% NPV 10988 minus NPV at higher rate, this one NPV is negative 25035. So net minus negative 25035 minus negative, okay. Okay, now we want to convert 12% into full number, the round number. 12% divided by 100 is equal to 0.12 because we want to make it round number 0.12. Insert formula again. 0.12 plus with, okay. Alright, 22 minus 12%. Let's solve the bracket first. 22 minus 12 is equal to 10 divided by 100 because we want to calculate percentage. Multiply by 10988. You get 109.8. And then this one 10988 minus, okay, you see minus and minus, negative and negative will become plus. Please bear in mind, negative and negative become plus, so you need to plus 25035. You can get 36023. Okay, so divided by this one, 1098.8, okay, divided by is 6023, which is 0.12 plus with, okay, take this one, 0.0305. Okay, just take 3 or 4 decimal point. Okay, so after that 0.12 plus 0.0305, you can get 0.1505. Okay, but you need to convert to percentage by multiply by 100. You get 15.05%. So this is the answer. As you can see, later on, where is my pen? Okay. 15.05 is located somewhere between this one. 15.05 is located somewhere between 12% and 22%. So there is how you get. Okay, what does that mean is if company's project profit is 0, they will only enjoy a return of 15.05% only. That is the interest rate that they have to pay. Okay, if the profit is 0. Okay, so that's why the answer is between 12 to 22 and 15.05 is somewhere between those two. Okay, so that is how you calculate IRR. Okay, we done with IRR. Okay, that means we completed the question. Okay, but we are not done yet. Perform an analysis based on A. Advise tenaga tech Berhad either to accept project or not. Provide research as well. Okay, for this one, question 2, analysis, discounted cash flow. Alright, so of course you need to do comparison table. Okay, merit. Okay, merit, indicator, and comment. Alright, first thing first, from question A, we already done payback period. The second question, we already talked about accounting rate of return. And then net present value, the third question. And then internal rate of return. Okay, now we're talking about merit. Merit is our answer. So therefore, you need to transfer your answer, which is payback period. Your answer is 3.39 years. Okay, accounting rate of return from question B, you got this one, 29.88. Okay, the third one, net present value, you got this one, 10988. Yeah, from question C. And internal rate of return, you get this one, 15.05%. Okay, for indicators, look back at the question. Okay, look back at the question. This one, just copy and paste in the question. Payback period 3.5 years. Accounting rate of return 27%. Net present value RM 8,000. Okay, and then internet rate of return 12%. Alright. For comment, okay, to comment that, you see, payback period is talking about the faster the better. I mean, the lower amount the better. You see 3.39 compared to 3.5. This one is lower than indicator. So we can say that is good. This is you, This is you, shading. This is you. This is a benchmark or target. Okay, for accounting of rate of return, 29.88 is better than 27%. So this one is good as well because return is usually we take the highest one. Net present value, which is merit, 10988 is better than 8,000, which is good. And the last one, internal rate of return, which is 15.05 is better than 12%, which is good already. So you can say that based on, what was the question? Yeah, tenaga tak berhad. Tenaga tak berhad should take this project because payback period, accounting rate of return, net present value, and internal rate of return is better than indicator. Okay, whatever is bad, you don't have to comment. That's it. Okay, because all payback period, accounting rate of return, net present value, internal rate of return is all better than the indicator. Okay, so we are done with this question. Right? So the difference between capital budgeting, financial management, and discounted cash flow for this subject is there is an additional features you need to calculate internal rate of return, which is you have to do interpolation as well. And then the analysis is additional of internal rate of return. Okay, so this is how you answer those questions. Okay, any question? Any questions so far? Yep, and Yanisha, any question?
Sir,
Yeah.
when you mentioning the IRR is 0,
Okay.
I cannot understand.
Yes.
The IRR is why 0?
I already answered that. IRR is 0 because look at this definition. Okay, look at this definition. This one. The definition for IRR is whereby the expected return or minimum. You see, in the mathematics or financial, the minimum, usually the minimum value is 0. So that's why, the definition of internal rate of return is whereby the expected return or minimum return for the project if net present value is equal to 0. That means the company wants to find the minimum, the lowest rate of return they can get. So how to ensure that they can get the minimum or the lowest return? By indicating or comparing that the NPV is equal to 0, because 0 is the minimum. Okay, 0 is the minimum value. Okay, so if you asking me, okay, why NPV is 0? Because NPV is equal to 0 means that the profit is 0. So for this internal rate of return, we want to calculate how much return the company can get if the profit is 0. So that is the definition. So I hope that I can answer the question. Yeah, because the definition said already. Yeah, the definition said that already. Okay. Any other question? Yep. Any question? Okay. No. All right.